Pandemic or no pandemic, we still have to pay our taxes. I know your 2020 tax bill may be the last thing on your mind right now, but if you want to take steps to help minimize it as much as possible, you still have a few weeks left to take action. It's that time again, time to tune out the hype and focus on the facts. Facts that matter to you, the income generation. Let's get started. Get ready to separate reality from myth.
With us, David Scranton.
David Scranton.
David Scranton.
David Scranton.
But David Scranton says, hey, not so fast.
How does it affect the markets? How does it affect the economy? Thanks to efficiencies in new technology and a staff of veteran analysts and portfolio managers, Sound Income Strategy strives to set new standards and bring institutional style investing to your portfolio. As we noted on a recent episode, it's no secret that potential President-elect Joe Biden has an extensive list of tax proposals, and these include raising taxes on households earning more than $400,000 and lowering the amount that you could pass on to your heirs tax-free. If Biden does not hold on to the presidency, then none of that is any concern. But even if he does, there's still no guarantee these changes will occur. And that said, the IRS has already announced some tax law changes for 2021 that you should know about. We'll talk about those on today's show, and most importantly, we'll share some tips from tax analysts on things you may still be able to do to help minimize your tax bill for 2020. Some of these options may no longer be available after this year, so you'll want to take advantage. We'll also review some evergreen tax strategies available for retirees and near retirees, and we'll talk about today's financial markets as usual. My co-host Jeff Small is unfortunately out this week, but we have plenty of interviews lined up. We'll talk to Robert Kiyosaki, best-selling author of Rich Dad, Poor Dad. We'll also talk with two retirement income store owners, Michael Eastham in Florida and Michael Stewart in Illinois. Michael has a special offer for all of our income generation viewers today. You're not going to want to miss this interview. But before we talk to our first guest, let's go over a few of the tax strategies that you may still have time to take advantage of as the year winds down. We all know the holiday season goes by quickly and is filled with obligations. However, taking time to review and revise your financial plan at this time can pay huge dividends in the coming year. Managing your taxes is obviously an important part of that process. Fortunately, as I said, there's still things you can likely do even this late in the year to give you an advantage. And here are a few examples. First, add up your healthcare expenses for the year. Although healthcare costs are only deductible after they exceed 7.5% of your adjusted gross income, in this modern age of expensive medicine and high deductibles, you might be surprised by how much you've actually spent. If you'll earn $100,000 in 2020, that means any healthcare spending in excess of $7,500 can be deducted. And this includes spending on things like dental care, prescription eyeglasses, and even mileage to and from your medical appointments. Next, give generously and wisely this holiday season. The CARES Act passed by Congress in response to the coronavirus this year created two new tax incentives to encourage donations. The first is a $300 write-off that donors can claim for giving cash to a charity. You can claim it even if you take the standard deduction when you file your taxes. And that's really the unusual part of this. The second incentive is aimed at donors who do itemize when they file, and that's in effect only for 2020. It allows you to deduct up to 100% of your adjusted gross income for cash donations to public charities, as opposed to the previous limit of 60%. Of course, there are limits and provisions to these rules. A smarter move for some people might be to donate appreciated stock to your favorite charity instead. This brings up a third potential strategy: dumping bad investments. Tax loss harvesting, as it's called, is a popular year-end saving strategy that involves selling certain securities at a loss to offset your short-term capital gain liability. It's not right for everyone, but not only can it possibly save you money in the short term, but it can also be the starting point for a broader conversation about the benefits of investing for dividend income versus investing just for capital gains. If you're in or nearing retirement, that's a conversation I believe that you should be having anyway, ideally with an advisor who specializes in retirement income. We'll share some more tax tips in just a bit, plus talk about some updates to the 2021 tax rules that you should know about. Now it's time to bring in our good friend and a great friend of the income generation, author and business owner Robert Kiyosaki, founder of Rich Global LLC and the Rich Dad Company. He's also the author of the best-selling personal finance book, Rich Dad, Poor Dad. Robert, welcome back to the Income Generation.
Well, thank you. I appreciate what you guys do, so thank you.
And we appreciate your input. So, let's start with the 800-pound gorilla. What are your general comments about the election results?
Well, this was more than an election. This was a turning of America from capitalism to socialism to possibly Marxism. So this was a very big turn. This was not, it's no longer macroeconomics, it's psychoeconomics now. And so last night was the Marine Corps birthday. I went to Vietnam twice as a pilot. And it was like a morning. We have a 4-star there. We have 2 full bird colonels. And I was a little lieutenant, but we fought for freedom.
Sure.
And my concern is we've lost our freedom. This is
So
more
it
than
sounds,
we lost our freedoms.
It sounds by your tone as though you're not all that optimistic that the president's court cases will be successful.
Well, that's a great question because it has nothing to do with the president. It has to do with social media. I mean, social media out of Silicon Valley with Zuckerberg and Dorsey and the Bezos, those guys run the economy now. I mean, what happened to freedom of the press? Yeah. So even if Trump wins and it gets back out there, they're just going to attack him more. So last night, like I said, with my Marine Corps birthday, November 10th, we don't fight for Republicans or Democrats. We fight for the Constitution of America. And this Biden win we're going socialist, and radical left socialism. And that's what I'm concerned about. And it comes out of Silicon Valley, as you guys know. You guys are the last holdouts. I shall pray for you tonight.
and policy-wise, if the Senate doesn't stay red, then we can find ourselves moving rapidly towards socialism, which is a real concern. So since we're talking about socialism, obviously that starts with tax rates, which is the topic of our show today, as you well know, and taxation in general. So what are your biggest fears tax-wise under a Biden presidency?
Well, just remember 1773 was the Boston Tea Party. America was founded as a tax-free nation. And my tax plans are the same. I'm going to make a lot of money. I'm not going to pay any taxes. And I've been doing that for most of my life. And that's why President Trump, he got nailed by the New York Times. They nailed him saying he paid only $750 in income tax. Well, the reason he paid only $750 in income tax is because he turns in his presidential salary. He doesn't need a salary. I don't pay income tax either because I don't have any income. There's 3 types of income: passive, portfolio, and ordinary. Ordinary income pays the highest taxes. So what that means is for all those people who are doctors, lawyers, accountants, the high-paid academic types, your tax rates are going to go up. But for the real capitalists, we're not going to pay any more taxes legally. 1773, Boston Tea Party.
I hope you're right that taxes are still friendly for business owners. And I know in your book, Cash Flow Quadrant, you talked all about some of the tax advantages. As part of the topic of the book, some of your tax advantages for business owners. But the real issue then is what it does for individuals. And so let's say an individual that's a high income earner or a medium, moderate income earner, that just taking a salary then, what do you think is likely to happen to that person?
Well, that's what I'm saying. It's going to be psychoeconomics. This radical left thereafter, I call it Robin Hood economics. Take from those who produce and put it in your pocket. That's what they're going to do. So as I was saying to you, is I'm a fan of Ayn Rand, her book Atlas Shrugged, and in that book, 1957, Anne said the capitalists or the producers will go into hiding. Well, this is where I'm hiding today. I'm on a little island in South Carolina, and my money is outside this country. So, and I do everything legally. I have no plans on going to jail and things like
Sure.
that. But the tax laws are written for the smart, for those with financial education.
And
that's
for
why
and
when
primary
Trump was in
and they're designed to benefit
discovery-
capitalists, as you said a moment ago. And I was going to say that before when you said you haven't paid a lot of taxes throughout your life. I was going to say, and most importantly, you've done it legally. So let's talk more about that coming up in a minute, right after the break. We need to take a break for now. And you stay with us. We have a lot more coming from Robert Kiyosaki in just a moment. We'll be right back. The Income Generation is now available on YouTube. Subscribe to The Income Generation so that you never miss a show. You can watch all your favorite episodes now in one place, as well as catch up with your favorite financial guests. Subscribe now to the Income Generation channel on YouTube. Now, you don't need me to tell you that interest rates are historically low in the wake of this COVID-19 crisis. And this impacts your financial strategy in many ways. However, in terms of tax planning, these low rates combined with current lifetime gift and estate tax exemptions may create a powerful estate planning tool for certain people. Understand that many estate and gift tax strategies depend on the ability of assets to appreciate faster than the interest rate prescribed by the IRS. Now, consider that the economic fallout of the pandemic is still depressing many asset values, and together these factors create a small window of opportunity to use estate planning techniques while interest rates are still low, along with the lifetime gift exemption, because it is at an all-time high. Now remember, this window will close, and possibly sooner rather than later. The current gift and estate tax exemptions are set to expire in just a few years, and a new administration in the White House could accelerate that timeline. An advisor who specializes in retirement income can help you review this, as well as other strategies more thoroughly. For example, you might have the opportunity to avoid potential tax penalties. How? By increasing your withholding before the end of the year. Obviously, the pandemic has created cash flow problems for many Americans this year. So it's smart to make sure your withholding and estimated taxes align with what you expect to pay while you still have time to fix the problem. If you find yourself in danger of being penalized for underpaying taxes, you can make up the shortfall or some of it through an increased withholding, again on your salary, or any year-end bonuses. You may still be subject to penalties for underpayments in previous quarters. However, increasing your withholding for year-end wages can still make a big difference in the size of any potential penalty. You can use the IRS's tax withholding estimator tool that's available on irs.gov to make the calculation. Another year-end tax strategy that you might want to consider if you own your home is going green. If you install alternative energy equipment such as solar panels, wind turbines, or solar hot water heater, you can claim a tax credit on your out-of-pocket costs. The value of this credit is dropping, but is still at 22% as of now. What's more, if selling your home is part of your retirement strategy, adding these energy-efficient improvements will increase its value. Coming up, we'll talk about some changes in store for the 2021 tax season, and later I'll share some evergreen tax tips, especially beneficial to retirees and near retirees. Now it's time to bring in our guest and good friend, best-selling personal finance author and businessman, Robert Kiyosaki. Okay, so before the break, we settled that capitalists do have a tax advantage in this country. I've got that. But really, capitalists of smaller businesses, think about corporate America. What happens, what I'm worried about, for example, is what happens to the stock market when corporate taxes go from 21, back up to 35. We got this Trump bump because they were lowered from 35 to 21, these big companies, and it doesn't take a lot of corporate profit, by the way, to get up in that top bracket. So is it just for small or medium-sized capitalists, but not for publicly traded companies? And if so, does that worry you even more about our stock market than you were worried when we had you on the show just a few weeks ago?
Right. The difference is President Trump and I are really good friends. His sons and I are better friends. And we're real estate guys. And if you understand tax law, Like I said, there's three types of income. There's ordinary income, portfolio income, and passive income. We don't pay taxes because I don't have ordinary income. I don't have a paycheck.
Mm-hmm.
And then I don't go for capital gains, which is, the stock market. So by going for passive income out of real estate, we pay zero taxes. I'm not recommending what we do because you've got to be fairly sophisticated. But if you go back in history, 1971, when Nixon took the dollar off the gold standard, the US dollar became debt. And the only way they could collect on the debt was via taxes. So real estate guys have a massive advantage over people in the stock market because we don't pay capital gains tax either. So let's say I make $1 million on a piece of property, I can do a 1031 tax deferred exchange into a bigger piece of property and pay no taxes again. But if I make $1 million in the stock market, I have to pay capital gains taxes. So there's
been some rumors. There've been some rumors under a Biden
exactly.
administration that they might eliminate the 1031 exchange, though. Now you start to cut into the bone of capitalism, don't you?
No, but there's still if you can't outsmart Biden and Kamala, you're not very smart.
Wow, I don't even know what to say after that. That is it's too bad we're not ending the segment with that particular comment. That would be a great finish. So okay, the average individual that, like you said, isn't going to be a real estate person, maybe doesn't want to complicate their life. They're not entrepreneurial. They're just going to work. They're going to put money in a 401k. They're going to save and invest. What are the best things that they should be considering from a tax perspective? Do you have any advice for the masses to try to help them even a little bit?
I really, I'll pray for you tonight because, like I said, we're going from macroeconomics to psychoeconomics. We're going to Robin Hood economics, which is take from those who produce. And if you don't make any changes, the next few years will be horrifying years. I hate to say that, but I've been, the reason I wrote Rich Dad, Poor Dad 25 years ago was as a warning. This was coming. Marx warned us, Orwell warned us, Huxley warned us, Khrushchev warned us. We're going communist. I hate to say that. Throughout history, that has always happened. And this election, like President Biden is really President Kamala. That's the person. And if you don't see it coming and I'm just going to do the same thing, then all I can do is pray for you tonight because they're coming after you. They're coming after anybody who works, who produces, who is actually a productive citizen. And that's where Ayn Rand's book, Atlas Shrugged, is crucial for people to understand. This was not an ordinary election. This was a change of America. And so that's why I always appreciate coming on your program because when I'm on CNN, they yank me. What we've lost is our freedom. Silicon Valley, Bezos, Zuckerberg, and Dorsey, I've been yanked off of my platform so many times because I just tell people what I know. And it's the subject of our show today. It's taxes.
So do you think
taxes, you'll understand capitalism.
Taxes are the tool to begin socialism, of course. But do you think that President Biden, if he becomes President Biden, President Biden will actually stick to raising taxes on those that only make more than $400,000 a year, or do you think he's gonna cut below that? We've got just 60 seconds left.
I don't really know, but like I say, it's President Kamala. Biden is dead man walking right now. I mean, it's radical left. If you can understand that we're going radical left, and if you can understand, this is why the Marines last night at the Marine Corps birthday, we were in mourning. Marines didn't fight for Republicans or Democrats. Marines fought for the Constitution of America. And the First Amendment, our right for freedom of speech, freedom of assembly, and freedom of religion was taken away. Next, they're going after the Second Amendment, which is our guns. So I'm just trying to say it's not Republican or Democrat. You can be a Democrat, you can be a Republican. But what Marines fought for was the Constitution of America. And it's getting crushed right now. And that's why I'm saying this was not an ordinary election. It's AOC and all those other commies out there.
Maybe you and I should host a little online prayer group praying that at least the Senate stays red and there's some checks and balances. It seems like At this point, that's the best shot that we have. We need to leave it there for now. Robert, thank you so much for being back on the show with us. Time always flies and we're having fun. And you stay with us too. We'll be right back in a moment, right here on The Income Generation. We'll be right back. The Income Generation is now available on YouTube. Subscribe to The Income Generation so that you never miss a show. You can watch all your favorite episodes now in one place, as well as catch up with your favorite financial guests. Subscribe now to the Income Generation channel on YouTube. I'm David Scranton. During my career, I found that most baby boomers have done a great job growing their retirement savings, yet many don't know how to convert their savings into steady income. And that is why I built the Retirement Income Store, to help hardworking Americans preserve their assets and establish steady streams of income.
If you're 55 or older, our free Retirement Income Kit is for you. It's chock full of information you need to know to get steady income during your retirement. Call 866-710-1749. Online at theretirementinComestore.com.
Last month, the IRS released a breakdown of next year's marginal income tax rates. This update occurs each year to reflect inflation and helps to reduce what's called bracket creep. That's when a taxpayer gets pushed into a higher tax bracket, not because they really earn more money, but because of rising inflation. These brackets are marginal brackets, meaning that different portions of your income, up to a specified dollar amount, will be taxed at a different rate. For 2021, the top tax rate of 37% will apply to individual taxpayers with income over $523,600 or $628,300 for those married and filing jointly. That's up from just over $518,000 for individuals and just over $622,000 for joint filers. Meanwhile, single filers with income over $209,425 will fall into the 35% bracket, as will joint filers earning just under $419,000. Again, the brackets are marginal, so your highest tax bracket doesn't reflect how much you're paying overall in federal taxes. If, for instance, you're a single filer in the 22% tax bracket for 2020, it means you don't pay 22% on all your taxable income. Instead, you pay 10% on some taxable income, 12% on another amount of taxable income, and ultimately 22% above all of that. Now, like everything having to do with the IRS, it can get confusing, which is why it's always best to have your financial advisor involved in any decisions or any changes you may be considering for your tax strategy. And that's especially true when you're in or nearing retirement and you have many new tax decisions to make. Decisions related to things like Social Security income, required minimum distributions, and as we already mentioned, estate planning. Getting back to changes for next year, you should also be aware that the standard deduction will rise to $12,550 for single taxpayers, and for couples filing jointly it'll rise to $25,100. And what's more, single filers age 65 and older can increase the standard deduction by $1,700 next year. And each joint filer, 65 and over, can increase it by $1,350 apiece, or $2,700 total. And as you probably know, you need to have more tax deductions than that standard deduction to make itemizing your tax return worthwhile. And even then, in certain cases, the standard deduction might still make more sense. Again, the right advisor can help you figure that out and help you take advantage of other tax-saving strategies. We'll talk more about that in just a bit. Now it's time to welcome our next guest, Michael Eastham. Michael is a CPA and founder of Fellowship Financial Group, a retirement income store located outside of Orlando, Florida. He's also the Amazon best-selling author of the book, Common Sense Income Strategies. So Michael, contested election. The president is making his best efforts to try to go to the courts and make his case. But as a CPA, what are your worst tax fears if he's not successful and we're truly in January with the Biden presidency?
Well, first of all, I don't think we're going to see impacts in January. It'll certainly be later in 2021. But look, if he just pulls out all the stops on the 2017 Tax Cut and Jobs Act, well then, I think we're going to see companies that are going to take their businesses overseas. It's almost a punitive, could be a punitive tax for corporations. That's one of the reasons why they left to begin with. So that's a big deal. And I also have a hard time believing that in the short run, he's not going to impact taxes on the middle class, everyday Americans who work really hard and try to preserve and reinvest in small business owners. So those are kind of my worst fears.
Yeah, especially if the runoff in Georgia goes blue, and they've got the House, the Senate, and the Oval Office. That's when that stuff could certainly happen. So okay, so let's get down to brass.
Carolina, pretty much. So that helps. At least it helps to solidify some of the base.
Yeah. Well, we'll see. It's a long shot at this point. A lot's got to go right for him. But okay, so let's talk about, regardless, what are some of the things that you tell your clients that are in or near retirement they could be doing in today's environment to save income taxes?
Well, first of all, of course, you do, related to the coronavirus, the CARES Act put a couple of things out there for people, whether they're retirement age or even a little bit earlier. The coronavirus related distribution, or CRD, it waives the 10% penalty from an IRA or 401k if you're under 59 and a half. And it gives you the flexibility to recognize a distribution from those accounts over a 3-year period of time. Normally, you have to recognize any distribution fully in the first year, but you have that longer period of time to recognize it. So that can help in taxes. If you need the income, if you need the money, maybe you were furloughed or something, and they allow you to pay it back over a 3-year period of time. Normally, you have a 60-day window to avoid any taxes, but the IRS is going to treat this payback as a custodian to custodian transfer over a 3-year period of time. So that's one thing. For folks who are affected by RMDs, typically, well, because of COVID, there aren't any RMDs. So this was certainly to help people that got hit hard by the stock market dump back in March. But it's not as big of an issue since the market's recovered. But what that does do is, if you're RMD age, then you may want to consider a partial or a full Roth conversion, because one of the benefits in this year, and you got to do it by December 31st, is that you have the RMD typically is not convertible to a Roth, but since there aren't any Roths, or not any RMDs this year, then you can convert the entire amount of your distribution to a Roth. And you've got plenty of benefits to converting to a Roth. So if you don't need that income, this could be a great time to do it. Okay.
All right. Great. What other advice? Those that live in high tax states, in case the SALT limits go away, maybe deferring property tax payments, things like that until 2021, maybe to get a bigger deduction on itemizing.
You can certainly do that. You can certainly do that, but also if you're charitably minded, qualified charitable distribution is a big deal. A QCD is something where you can take money from your 401k, your IRA. If you're, of course, you've got to be 70 and a half. But if you're charitably minded anyway, and you were affected now because you're not able to itemize, the limit of the standard deduction increased so much, a lot of people aren't able to itemize anymore. But you could take money and give it to a charity directly from one custodian to the 501c3, and the IRS recognizes that as an RMD, and you don't have to report that as taxable income. The catch here is that you've got to do it by December 31st. That's a hard stop. So that's a big deal.
Yep, that's great. So getting away from taxes for a minute, in the minute and a half we have left, what are your biggest concerns right now for the financial markets under a Biden presidency, especially under a blue sweep if that ends up happening, for people like our clients, our viewers, our listeners that are close to or in retirement?
I think some of the biggest concerns is that people panic. If people start to panic, then it's a self-fulfilling prophecy. And unfortunately, the media doesn't help much in that regard. And then the second thing is that if the government really starts to go towards this liberalized, socialized socialism model, well, it's very concerning. They're just going to start cranking the printing presses higher and higher, even more than they already have. Not that they haven't printed much this year or in the last few years, but even more than they have in the past to try and fund some of these ridiculous programs. And that does create a substantial concern in terms of the financial stability of U.S. markets. So, and also the perception of financial strength overseas. So those are some of the things that I struggle with. I think most people really need to take a hard look at the amount of income they need. They need to look hard at the sources of that income and the reliability of that income, so that they can feel comfortable and at least a lot more confident that they're not going to run out of income before they run out of life in retirement.
Yep. Always good words of wisdom, Michael. Thank you so much for being with us. And you stay with us too. We have more to come on the income generation. We'll be right back. Taking advantage of the bigger standard deduction offered by the IRS once you turn age 65 is just one tax strategy that you can use every year once you've reached retirement age. However, there are others. For example, if you become self-employed after you leave your job, as a consultant, for example, you can deduct the premiums you pay for Medicare Part B and Part D. You can also deduct the cost of supplemental Medicare policies or a Medicare Advantage plan. Another strategy that might work for you involves spousal IRA contributions. Even if you're no longer working, but your spouse still is, he or she can contribute up to $7,000 a year to an IRA that you own. As long as your spouse has earned enough income to make that contribution, this tax shelter remains available to you. One more popular strategy is to have any payout you receive from a pension, annuity, or IRA sent directly to a rollover IRA instead of being sent to you. As long as you don't need the money and the check is made out to that account and not to you personally, you'll avoid the automatic withholding of 20% that's required by the IRS. Again, these are just a few examples of strategies that may or may not be right for you, depending upon your situation and your retirement goals. The right advisor can help you make that determination and help you coordinate these strategies with your broader retirement income plan. Now it's time to bring in our next guest, author and podcast host, Michael Stewart, founder of Crystal Lake Tax and Financial, a retirement income store located just outside Chicago. He's the author of the book, Purpose-Based Investing, 9 Lessons to Rescue Your Retirement from Wall Street. Now you're going to want to stick around because Mike has generously agreed to provide a free copy of this book to all of our loyal listeners. Mike, thanks so much for being with us today.
Thanks for having me again, Dave.
So, politics aside, there's clearly a difference in tax policy between a President Trump and a President Biden. So with now the news channels, most of them announcing, President Biden's going to be in the Oval Office in spite of the president's lawsuits and so on. What are your clients telling you? What concerns about taxes are you now hearing as somebody who's talking to your clients literally every day?
Yeah, the biggest concerns surrounding taxes, especially after this election, have been around the concerns that we were already a pretty indebted nation coming into 2020. And then we've layered on another $2 trillion of stimulus, anticipated another minimum $3 to $5 trillion coming around in the spring in additional stimulus infrastructure packages. A lot of our clients are saying, how are we going to pay for all this? And most of our clients are either in retirement or near retirement. And why that's important is because many of them are going to be living on a fixed income now. And they don't want the IRS to become an even bigger part of their retirement income plan.
Yeah, most retirees are under $400,000. And Joe Biden has said, look, if I get in, I'm going to raise taxes on those over $400,000. In fact, if all the SALT limitations kind of go away, it might be able to allow more people to itemize, so it might help some people. But how about corporate taxes? How about the stock market? A lot of people are still invested in the stock market when they're retired, at least with some of their money. And, we had this great Trump bump because corporate tax rates went from 35% down to 21%. What if they go back up?
Yeah, Dave, there's so many different things to kind of dice apart on and what you just said there. And I'll even kind of spend the beginning of it on, we're only going to tax, the rich, those that make over 400,000. Well, that's how it always begins, right? The only way you're going to get the majority of people to say, sure, let's raise taxes, is if you just take some bar that's so high that people can't fathom it. Think about Social Security. In the 80s, when they said, hey, we're only going to attach the wealthy and tax the wealthy for their Social Security benefits, now about 2/3 of individuals pay some sort of tax on 50 to 85% of their Social Security benefits. And mom and pop making $50,000, $60,000 a year in retirement and having their Social Security tax in retirement, they don't feel wealthy. So I be careful about listening to any politician that tells you we're only going to tax the wealthy, because that's not really going to stick around. On the corporate side, there's really two things. From an investor's perspective, there's the threat that we're going to start taxing capital gains at income tax rates. So instead of either 0, 15, or 20%, that could be substantially higher going forward. And then that's going to put some downward pressure on, using stock market gains as part of your income strategy. And from a corporate perspective, one of the things that made us more competitive globally in the last 3.5 years under the Trump administration was by dropping the corporate income tax to make us more competitive, to try to bring more jobs home, hire more people, build more factories and things locally, within our borders. If we raise corporate income taxes, we're basically just giving a permission slip for companies to look elsewhere.
Yeah, and then if we have jobs going overseas, then we've got a real, then we have a real problem, and not necessarily for your clients who are retired or near retirement, but for other people watching our show today. So legitimate concern. We take a quick break here. You stay with us. We have much more coming up in just a moment from Michael Stewart. We'll be right back. Welcome back to The Income Generation. We're here with our good friend and guest, Michael Stewart. So, okay, it sounds like you're skeptical about Joe Biden's promises that eventually those tax increases will kind of sneak their way into levels certainly far under $400,000. So can you give our viewers, our listeners, just 2 simple tax tips that might apply to them if they're retired or approaching retirement, in terms of how they can at least have a shot of saving a little bit in taxes?
Yeah, there's 2 different ways to look at it, Dave. I'll give you a kind of a near term, something that you should be speaking with your advisor about now, especially given the volatility that we have in the world this year, and then a more longer term strategy on how to take advantage over the next few years. So the first thing that you want to look at for the near term, over the next 30, 60 days or so, is doing what you call tax loss harvesting. Take advantage of the fact that we are at near historically low income tax rates, very low capital gains tax rates. So if you have some winners, don't kind of hesitate to reposition those. Take some of those gains off of what's been a 10-year bull market run. On the tax loss harvesting, maybe you have some good investments that just happen to be negative for the year or down in value. If you sell those, you can help offset some gains by making those sales. Now, talk to your advisor. This is giving you investment advice, but essentially, take a look at your portfolio and be a little tactical towards year end here and take advantage of some of the seasonality. The more important thing, and what we're talking with a lot of our clients about, is the tax burden that's been built up in your IRAs, your pre-tax 401ks, and start putting together a Roth conversion strategy. And I don't want to get too wonky on it as far as how that all happens, but it's basically paying a little bit of tax now so that your money's going to grow completely tax-free going forward. So that's definitely a concept that you want to take advantage of while we still have historically low income tax rates as well as capital gains tax rates.
Mm-hmm. That's all great advice, and you're right. Tax loss harvesting is great, but also realizing some of those gains. If you as a viewer, as a listener, really do think that capital gains rates are likely to go up with the Biden presidency, then taking some of those gains and paying them maybe a little early, but at a lower rate, may not be the worst idea in the world. So speaking of that, though, how does that affect markets? If there's a little bit of a sell-off at the end of the year for that purpose, it could affect the stock market negatively. And I don't think it would be a huge deal, but we've just had a huge bump over the last couple of weeks here, especially with this concept of a new vaccine. The optimism seems to have taken over the markets. We're hitting record highs. And it's not just tech stocks anymore. The tech stocks are going back, and your more traditional companies are moving forward, companies that pay high dividends. So, market-wise, what would you like people to know that is important for those that are retired or approaching retirement?
Yeah, for those approaching retirement and in retirement, the key thing for them is just make sure that they have a plan for how they're investing. So, this nice rally that we've had the last couple of weeks, coming off the election, that's great, and we'll take it. But understand the things that have rallied, much like you talked to, have been the things that have been out of favor for the last 6 or 7 months. So the tech stocks have been selling off, while your banks, your industrials, your manufacturers, your hospitality stocks, travel stocks, those are the things that have been rallying in anticipation that the announcement on the vaccine, once we roll into 2021, it's going to be blue skies ahead. What I would caution those in and near retirement is that even if the vaccine is fully effective, and we all hope that it is, we're looking at end of Q2, Q3, maybe even the end of next year before there's a large scale vaccination going on. So this is still going to be with us for a long period of time. And what I don't want people to misunderstand is, although the economy is improving off of the March lows, the stimulus has weared off the last few months, and we're starting to see that in the job market for new unemployment claims. As we go into winter, or what Biden would call the dark winter, we have to be concerned about stay-in-place orders and how that's going to affect the economy. So I would tread cautiously going forward. That this recent optimism is great, but this is still going to be with us. So you need to position your portfolio for what's ahead, not where we came from.
Yeah, and the markets are forward-looking, and if you're going to be optimistic, you want to be cautiously optimistic, because again, with infection rates going up, you're absolutely right. That's certainly a headwind that we need to be concerned of. Great words of wisdom as usual there, Mr. Stewart. Thanks so much for joining us today. And don't forget that Michael Stewart wants to send you a copy of his book, Purpose-Based Investing, at absolutely no cost to you. All you have to do is email Mike's office at support@crystallaketax.com. Again, support@crystallaketax.com, or give his office a call. You could even text BOOK 2020 to 815-403-8425. That's 815-403-8425 to get your copy of Purpose-Based Investing. You can learn about how these income strategies we've talked about today can work for you. Stay with us. We'll be back here in a moment on the Income Generation. The Income Generation is now available on YouTube. Subscribe to the Income Generation so that you never miss a show. You can watch all your favorite episodes now in one place, as well as catch up with your favorite financial guests. Subscribe now to the Income Generation channel on YouTube. I'd like to thank our guests Robert Kiyosaki, Michael Stewart, and Michael Eastham for joining me today on the Income Generation. Most importantly, I want to thank you, our new and returning viewers. As I said at the top of the show, I realize this isn't the time of year when most of us are thinking much about taxes or finances in general. On the contrary, it's typically the time of year when we intentionally put those thoughts aside to focus on family, friends, and enjoying the holiday season. At the same time, odds are that you'll be able to enjoy the season even more, knowing that your financial house is in good order and that you're doing all you can to help minimize risks, take advantage of opportunities. That might mean new investment opportunities emerging in today's market. It might also mean opportunities to help minimize your 2020 tax bill or to incorporate smart new tax strategies into your long-range financial plan. Strategies you may still have time to implement this year include things like deductions for healthcare costs and charitable giving, taking advantage of historically high gift and estate tax exemptions, increasing your year-end withholding taxes, tax loss harvesting, or investing in energy-efficient home improvements. More evergreen tax strategies that might work for you include spousal IRA contributions, deducting your Medicare premiums, and taking advantage of the standard deduction bonus available to those age 65 and over. Now, as with every aspect of financial planning, there's obviously no one-size-fits-all tax strategy. What works for you may not work for your neighbor. And by the same token, what worked for you last year may not be right for you this year, depending upon a variety of factors. Bottom line is that having the right tax strategies in place is an essential part of financial planning, especially when you're in or nearing retirement, seeking to help minimize your tax burden while trying to maximize your retirement income. And a financial advisor who specializes in retirement income can help you do just that. As always, stay safe and thanks for watching. If you're close to or you're in retirement and you're concerned about your money, it's essential you stay informed and up to date. And right here is where you can do it on the Income Generation. I'm David Scranton, and we'll see you next week. The Income Generation is now available on YouTube. Subscribe to the Income Generation so that you never miss a show. You can watch all your favorite episodes now in one place, as well as catch up with your favorite financial guests. Subscribe now to the Income Generation channel on YouTube. I'm David Scranton. During my career, I found that most baby boomers have done a great job growing their retirement savings, yet many don't know how to convert their savings into steady income. And that is why I built the Retirement Income Store, to help hardworking Americans preserve their assets and establish steady streams of income.
If you're 55 or older, our free retirement income kit is for you. It's chock full of information you need to know to get steady income during your retirement. Call 866-710-1749, online at theretirementinComestore.com.